What's going on, guys? This is Chandler Smith, and if there's one thing I know to be true, it's that there is nothing certain in life except for death and taxes. However, that doesn't mean that there aren't certain strategies or tools that you can use to avoid and defer taxes. And so in this video, I'm gonna talk about my top 10 and maybe even a couple other ways to avoid and defer taxes. We're gonna talk about the legality of all of these. We're gonna talk about the risk involved. And hopefully this video is going to help you to figure out the tax situation in a way that, I don't know, you're happy with the end result. So with all of that being said, let's jump into it. All right, guys, if you're new to the channel, you know that I manage hundreds of sales reps. I also own a little north of $25 million worth of real estate, and I have this YouTube channel. All of these things make me money, which in turn causes me to owe taxes. Now, I have met with dozens of people to find the best way to handle, defer, and avoid taxes. Not because I'm not a good American. I've actually paid a ton in taxes. I believe in taxes. However, I believe that you need to know the rules of the game so you can play properly, and the government has incentivized you to do certain things that can help you with your tax burden. And so we're gonna talk about all of the different things that the government's given you / incentivized you to do. The one thing you need to keep in mind when discussing or trying to figure out taxes is that if there is a loophole that you find, it usually has been incentivized by the government. You also need to keep in mind that if it sounds too good to be true, it probably is. And we're actually gonna talk about a couple strategies that people will push on you, but you need to understand the risk and the potential negatives that come with these strategies. Now, I'm gonna talk about all of the strategies. I'm gonna tell you my favorites, I'm gonna tell you my least favorites, I'm gonna tell you the ones that I think are dangerous that you should stay away from, and I'm gonna tell you the ones that I think are, safe. They still sometimes come with risk, and that's why you need to make sure you mitigate that risk by doing things properly and legally, because you should pay taxes, right? That's part of the life we live. That's what you owe back to your society. However, there are a lot of loopholes and other things that the government's incentivized you to do that if you use them properly, you win and the government wins, and that's our end goal. Now guys, today's video is gonna be a little bit unique because I'm gonna share with you my favorite way to avoid taxes first, then I'm gonna go back to my least favorite and work back up to my favorite. Now, it might sound weird, but the reason we're doing this is I believe the best way to avoid taxes that's going to bring you the most joy and the most happiness is by giving back. Now, there are a myriad of ways to give back, whether it's to your church, to your community, to multiple different organizations that help people. And I think what's so cool about giving back is you need to find the best way for you to give back. Because if you do that, not only are you going to be able to put money into an organization that you care about, you're gonna be happier and you're just gonna live a better life. I promise you, those that give back, it always comes back. And that's why today I decided to team up with an organization called Be Charitable. All right, guys, if you follow the channel, you know that I very rarely, if ever, do sponsored videos. However, this video is sponsored by Be Charitable. And the reason that I chose to connect with them is because everything that they do is based around helping you to give back. For the extremely wealthy, there's something called a donor advised fund. They're extremely expensive to start and extremely expensive to maintain. You also have to get lawyers and accountants and a myriad of other people involved. What's so cool about Be Charitable is they've taken all of the guesswork and all of the additional expenses out of giving back. You hop on to Be Charitable, and with just a couple clicks, you've got your account or your fund set up. And so if you decide, hey, I want to give back 12% of my income every single year, you can have that taken out every month. Or if you procrastinated till the very last day of the year, you go and you put all of the money into the fund, even if you don't know which organizations you're going to give that money to. You now get all of the tax advantages and you get that back in one receipt. Again, with just a couple clicks of a button, you can go, you can put it into your fund, you can give it to the organizations you believe in, and you can hold yourself accountable, you can help get your friends and family involved, and it all together just makes giving back so much easier. I really feel that this organization is going to help you to give back because that's what you should do, and that's why for me, it was a very easy partnership to team up with Be Charitable. So if it's something you guys want to hop on and start your own fund, I've attached the link below. You can go and click it, check it out, and I promise you, you're going to love it. And again, it's completely free, but if you want to tip this company for all the good that they're doing, you also have an opportunity to do that. Now that we've covered all of that, let's jump into the video. Now guys, one more point I wanted to make about Be Charitable. This truly is an organization that I believe in. I've included that link down below. And the reason I believe in it is I do believe in giving back. I think that there are huge blessings that come from doing that. But also this makes it so easy and so beneficial for tax planning and for structuring your business in a way that you can give back and you can get the benefits in the process. So that link is down below. And now that we've covered my favorite way to avoid taxes, which is giving back, we're gonna jump into my least favorite way to avoid taxes. And it's actually a strategy that I haven't ever used, but we're gonna jump right into it. So the first one is land easements, or they might be called conservation easements. Now, this is a strategy that I have heavily researched, but I've never actually done, and I'm gonna talk about why. But first off, I'm gonna give you layman's terms explanation on what exactly it is. Essentially, you go to a company. You should not try and do this on your own, because if you get audited, it's almost guaranteed that you're gonna be screwed. But you're going to a company and they find a piece of land. Now, the way that the government is supposedly incentivized to like this is they're gonna find a piece of land that is going to be given to the government. They're gonna go in, they're gonna run all kinds of fancy reports that say, hey, this is what the value of the land could be, and you're gonna buy a chunk of the land. And a lot of times these companies are saying, hey, we bought the land for $100,000, but actually with our fancy reports, it's worth 5 times that. Here's where it gets sketchy. The company says, hey, it was worth $500,000. You get $500,000 off of your taxable income. That means, because we're taking $500,000 off your taxable income, you save $185,000 in taxes, but you only had to spend $100,000. So if you're looking at money out the door, only $100,000 goes out the door in this land easement. You save $85,000 because you would have had to spend $185,000 in taxes. Here's where it's sketchy though. If the government comes in, they audit you and they say, hey, you said 3 to 4 times, it's only worth 2 times, or hey, it's only worth the money you spent on it, or hey, you overspent on it. All of these things are options, but let's say they come back and say, look, you only get $100,000 off your taxable income. We know you paid the money for all these fancy reports and whatnot, which is another number we're not even taking into consideration because you've got to pay the company to do the conservation easement. So now you're tied up with the government. Let's say you go through the process and they say, well, it's only worth $100,000 off your taxable income. Well, now you spent $100,000 in hopes of saving $85,000, but you've lost $100,000 and they're saying it's only worth $100,000. On that $100,000 you lost, you're only saving the 37% in taxes, so $37,000. So you spent $100,000 to save the 37, it doesn't make sense, right? You're in the negative because of the audit that you went through. And I've seen this happen to people, and not only do they have the stress of an audit, but then they end up owing taxes and they lost money because they gambled on it. Now, this isn't always the situation. A lot of times it'll come down to 3x or 2x, or it'll stay at the 4 or 5x, because a lot of times there are companies that have gotten through these audits. But from my perspective, this is just a play for people to avoid taxes. And anytime you're doing it just to avoid taxes, you're not like, oh, I really want to give back to, this land and, I'm cool with whatever comes of it. No, you're just trying to avoid taxes. That's usually where I can see people getting burned. Now, if you investigate Donald Trump, he's used these and he's capitalized pretty big on some of his golf courses and other things where he's got the right people, they've done the right things. Supposedly, I'm not going to say yay or nay to that. I haven't audited it and I don't know how. But there are some big players that use this strategy. You just have to understand there is large risk. There's also large payoff though, because if you're going to have to pay these taxes and now you can avoid them, that's pretty cool. It'd be pretty cool to be able to avoid taxes and have the government audit it and have them say, oh, you know what? This is cool, it passes through. I've just seen so many friends that have tried this strategy, they get audited, it makes their life miserable, and they get kind of burned. So I know a lot of people research this because it looks good, but if it sounds too good to be true, odds are it might end up being too good to be true. All right, on to the next strategy. And again, I'm going least favorite to favorite, so hang with us. The next one is captive insurance policies. And guys, I'm gonna be honest, if I try to explain this, it's gonna take like 30 minutes, so I'm gonna give you an extremely watered down version. You can do research on your own, but this is another strategy that I have researched heavily, and I decided the risk wasn't worth it because I believe there are other ways to avoid or defer taxes that have substantially less risk. Essentially what this is it's self-insuring your business. And there are lots of different options where you can self-insure with a group of people or with yourself. Again, there's a third party that helps you set all of this up. And the thing that I found sketchy is a lot of times they were wanting me to insure my business for something that I wasn't really worried would happen to my business. And that's the point, because if lots of companies get together, they're all insuring their business for something that they don't think they even need to insure their business for. They're putting in money, then premiums and all of that goes into it kind of stacks up to where there's money in reserves that then you can borrow against and in some ways get access to this money while avoiding taxes. Now, it's so much more intricate to that, and I'm not saying this one is a hard no. I would say this is less risky than conservation easements from the research I've done, and honestly, I'm sure people that do these are gonna be like, Chandler, that was such a watered down crap version to avoid taxes. It is something you can look into if you're desperate. However, it's just something that I don't think it's worth it because again, they're insuring their business a lot of times for something they know is never going to happen to their business just to avoid taxes and find kind of a tax shelter. Now, depending on your situation, might be an option to research. It's on the table. However, I feel like the risk is pretty high. There are lots of intricacies, and at the end of the day, it does seem a little too good to be true for me because you're jumping through a lot of hoops, you're doing a lot of complicated things, you're paying a third party just to help you avoid taxes where if you get caught, you could end up getting burned. You're probably wondering why I've covered two things now that I personally haven't done. Well, the reason is because these are things that were heavily pushed on me that after doing my research, I just didn't feel comfortable with. And I found other strategies that are way better that have helped me avoid or defer taxes that I feel like have substantially lower risk. Now guys, this next portion, the next like 5 or 6 I'm gonna hit on, these are again things that, well, I can't say I haven't done them. I did do them when I was younger, less experienced, less educated, because I could see the potential upside. We're gonna talk about IRAs and 401ks, and we're gonna talk about the pros and cons, but we're also gonna talk about why I don't like them. Now, first off, you need to understand these are all kind of in the same grouping. You've got a Roth IRA, an IRA, a Roth 401k, and there are even other options similar to this that I won't even cover. There's defined benefit plans. I'm gonna kind of hit all of these in one grouping. Essentially, all of these are retirement plans. And what the government is pushing you is they want you to put aside money so that when you hit 65 plus, you're in a place where you've put aside money and you can survive and you don't have to rely on the government. Makes sense for them to find a way to incentivize you to put away money for the future. Now for me, I think the best way to put away money for the future is investing in other things. Even people like stocks and bonds and those options, I feel like those are good options. But I feel like I like having access to my money and I like being liquid, but all of these IRAs, 401ks, everything else, they make it so your money's not liquid because if you take it out before you're 65 plus, you get penalties on that money, so it kind of defeats the purpose. However, the principle behind it is you get some tax benefit. Now, a Roth IRA or 401k is where you're going to put money in after you've already paid tax on it, but all of the money you make on it in the process, you won't have to pay tax on. So it's beneficial because it's like, hey, if I know I'm not gonna touch this money till I'm 65, I'm gonna put it into this mutual fund, stock, bond, whatever I'm gonna put it into. Maybe you can't put it into bonds. Not sure on that. You can research it with your guy. It's the principle I'm covering here. But if you put it into a Roth IRA, a Roth 401k, you cannot touch it. But when you take it out, if it's doubled, tripled, quadrupled in value, you don't have to pay tax on that, which is awesome because you pay tax on it, you put it away, and then you know all that money you pull out at the end that you can use to survive on, you're not gonna have to pay tax on. The other option is kind of flipped where you don't pay tax on it. So you're gonna take the money, you're gonna put it into the 401k or the IRA, and any of that money, you actually avoid paying taxes on it for that year. So it goes in, it sits there, you will have to pay tax on the money that made, but it gives you this chance where you can say, you know what? I've got this much money I just don't want to pay tax on. I'm gonna set it aside, I'm gonna let it make money. I'll just pay taxes on what it makes when I get older, but at least now it kind of helps me avoid taxes and put this money straight in to where it can start making me money. You can see how the government would incentivize you to do one of these plans because you're like, oh, I get to avoid taxes. But you've got to remember, all right, let's say you put $10,000 into one of these accounts and it's like, oh, I was gonna pay 37%. Cool, I just avoided paying $3,700 in taxes, but I also locked up $10,000 that I can't touch till I'm 65. Hopefully it makes money in the process, but to me that didn't make sense because I like to have access to my money. And so it's like, oh, the government's throwing you a little bit to get you to lock up your money so you have it for retirement. Again, that's cool if you suck at any form of investing, if you suck at getting into real estate, if you suck at other options and you don't trust yourself to make a ton of money in the process so that by the time you're 65, you're not worried about money. If you fall into that category, I think this is a good place for you to put your money. If you don't, if you're like, no, I'm confident in my ability to invest, I'm confident in my ability to use that money better than the little bit of tax savings I might get on it so that it can make me money and I can have access to it and I can continue to make money with it and put it where I want to put it. And as the world changes, I can access it and move it and manage it. That's what my thought process was. So my first year I actually made money, I did put, I want to say like $7,000 into an IRA. And that's gone up in value, right? I avoided paying tax on the $7,000. It's gone up in value, I don't know, $3,000, $4,000 since then, which is cool. But it's not that cool because I can't touch that money till I'm 65. And by the time I'm 65, whatever that's worth, hopefully I don't need it and I don't even care about it because I've invested my money properly. So after that year, I decided I didn't want to do a Roth IRA or 401k. I didn't want to do a normal IRA or 401k because I found other strategies that were better. Now, a lot of you are saying, Chandler, what's the difference? Well, an IRA limits how much you can put in. A lot of times a 401k, your job might offer and they might match, which I can see some advantage to that. Like if you put in 10K, not only are you not paying tax on it, but they're putting in another 10K, that'd be cool. The other thing about 401ks is a lot of times they have larger amounts you can put in, and as your income gets higher, they don't have limits. With IRAs, they have certain limits where you're not even allowed to put money in if your income is over a certain amount. So you need to look into both of those and see the pros and cons. They both have their pros and cons, but in my opinion, for my situation or anyone else that is confident in keeping their money liquid and making more money than the amount they'd save in taxes, I would say, look, don't put your money in one of these things just to avoid a little bit and then lock up that money forever, because in my mind, that doesn't make sense. Now, when you sit down with an accountant, they're gonna wanna push you this direction because it's an easy answer when you come into them and say, dude, this sucks. I have to pay all this in taxes. And they're like, oh, put some money in a 401k. That'll save you this much in taxes. Because they're focusing on what you'll save. They're not focusing on how much your money you're spending and tying up until you're 65, which in my opinion sucks. Now, one other advantage I have to mention about IRAs and 401ks is they have delayed deadlines. So let's say that you get to the end of the year and you forgot to do any tax planning. The year's come and gone and you're in the next couple months. You actually have a window where you could still put money into an IRA or a 401k, and those windows are different. But if it's in January or February and you're like, crap, I'm screwed, I didn't put my money anywhere, now I'm just gonna have to pay the tax, and an IRA or 401k does make sense to you, you've still got time to reach out to a planner and say, hey, where could I put this money and work through it if you think that's the right fit for you. For me, it's not. And guess what else? I've got other ideas you can use even after you've missed the end of the year that we're about to talk about. However, the next one does not fall into that criteria. The next one, which is one of my favorites, is one that you have to do before the end of the year. This next one is starting a business or putting money into your business. Now, here's the thing you have to keep in mind with this. If you have things that you truly believe are going to push your business to the next level, they're going to help you make more money, they're going to benefit your business, then go and spend that money before the end of the year. Examples of this are new computers, new equipment, new websites, marketing. There's a myriad of different things where if you spend it on your business, you get to write it off. Now, one thing you need to keep in mind that is a negative to this is you've got lots of things you can do. You can buy business vehicles, you can buy all kinds of different equipment, materials, a myriad of different things. Problem is this affects your taxable income. which is a good thing and a bad thing. It's a good thing because you'll pay less taxes, but I see a lot of people, they get to the end of the year, they blow a ton of money on their business, so they claim nothing on taxes. Their next year, they're gonna ramp up their business, but then they come to me and they say, hey, I wanna get approved for a loan so that I can buy a rental property. And I'm like, cool, but you don't show any taxable income because you wrote everything off. Now, when a bank comes to look at you to give you a loan and they say, hey, you didn't pay any taxes, you're not showing any taxable income, a red flag is gonna go up and they're gonna be like, dude, I'm sorry. You need to show income so that your debt to income ratio looks good so that we can lend to you, and we can't lend to you because you wrote everything off. You're not showing any taxable income. Now, I also know people that will lie or get shady or do dishonest things and make up expenses. And one, if you get audited, you're gonna get screwed, so don't do that because you're gonna burn your business down and end up in prison. Not worth it. But two, they also put themselves in a place where then they can't use leverage, which would help their business, would help them to invest in real estate. And so it's just not worth it. That's why every year I sit down with my accountant and my loan officer and I say, all right, guys, this is money I think that would be good to spend on my business. But how's that going to affect my debt to income ratio? Because I want to buy this much in property and I want to make sure that my taxes show that I'm going to be able to do that. Now, early on, I would always do this. I've gotten to the point now where the last strategy I use and the fact that I make a lot of money puts me in a place where I don't have to worry about it as much. But it's great to sit down with your accountant and your loan officer, because if you watch this channel, odds are you're also a real estate investor. If you're not, you should be, because not only do you make a ton of money, but there are tons of huge tax benefits, which we're gonna jump into in just a minute. The last point I wanna make about spending money on your business is a lot of times people force expenses because they don't wanna give money to the government, but those expenses don't help their business. Example of this is like a business vehicle. I see a lot of people do this all the time. We're like, yeah, I bought a business vehicle because it was over the weight limit and I could ride it off, but I overspent on this car that I didn't really want to avoid the taxes. You've got to remember, every dollar you save only saves you 37%, even if you're in the highest tax bracket. I see a lot of people that are in the 20% tax bracket and they're buying all of this stuff to avoid paying 20%. And it's like, dude, you just spent $1 on something you didn't need and didn't want to save 20%. That doesn't make sense. So make sure when you're putting money into a business that that expense actually justifies being spent on. Because if you're just trying to avoid taxes, again, that's a terrible strategy. All right, guys, now we have gotten to my absolute favorite way to avoid or defer taxes. However, I do want to make one more pitch towards giving back. Every year I give back a large amount of money because I believe when you give back, you get back. And it makes me feel good and it makes me happy, and it's awesome that I can go and support someone else or an organization that needs my help, and I don't have to pay tax on the money that I made that then goes to them, to helping them. So again, if you want to use Be Charitable, we've put the link down below. It's a super awesome organization, and if you don't know what you want to give back, but you want to hold yourself to giving back, or it's the end of the year and you're like, crap, I wanted to give back, but I don't know which organization, go put it in there. It's gonna be awesome. It's a huge advantage to you, and it's something that honestly, it kind of bails me out at the end of the year if I didn't give back all that I wanted to give back, but you know, it's January 31st and I'm like, crap, I like this organization and this organization, but so now you probably think negatively of me because I wait to give back till the end of the year. I give back throughout the year too, but I have found myself in that place where I wanted to give back more at the end of the year because I made extra money that last month of the year where I'm like, hey, let's give some back. And this is going to help you as it's helped me. So link in description now to get to my next favorite, which is my favorite, just defer other than give back. And that is using cost segregation, accelerated depreciation, 1031 exchanges. If all of these things are going over your head, I'm gonna give you a very brief description, but we're gonna do more videos about this in the future. Essentially what it is if you are a real estate professional, or if you're not, you can still use it on your passive gains. But if you are, so let's say you're a realtor or a real estate investor the majority of your time, there is an hour requirement and there is a time requirement. So you've got to put in like more than half of your time goes into your real estate business. What this gives you the ability to do is when you purchase an investment property, you can accelerate the depreciation on that property. For example, if you bought $1 million property, Usually you would have to depreciate that over a 27.5-year schedule. You can accelerate that so that you can depreciate up to 40 or 45% of that property year one. So now you've got more depreciation than what the property made you that you can also use against your other income. The reason that I love this strategy is it does great if you ever go through an audit, because the government is incentivizing you to do it. They want you to buy rental properties. They want you to invest in real estate, and they are allowing you to depreciate it. Because once you've depreciated it, you've depreciated it. And if you ever sell it for gain, you've got to then pay that tax. That's why 1031 exchanges are awesome, because they incentivize you to sell and then buy more properties, which the government for some reason really likes that too. And you can move that over into the next property. So if you depreciate the full $1 million on the property, but then you go buy a $4 million property, then you have another $3 million you can depreciate because the $1 million carries over. Now, if this is going way over your head, don't stress out. Essentially, all that it is when you buy real estate and you do cost segregation, you accelerate that depreciation, you just need to understand that on the real estate, if you paid 25% as a down payment to buy the property, you've got an additional 15 to 20% of the purchase price of that property that can be used against other taxable income. So let's say that you make $1 million in the year, you spend $250,000 on a rental property, that's going to give you $400,000 against your taxable income. So when you make $1 million, $400,000 of what you made, you don't have to pay tax on, and you only spent $250,000 of that $400,000 buying this property. So it's a really, really cool strategy to be able to avoid, and not really avoid because you're deferring it. You just need to realize if you ever sell the property, you're going to have to pay the tax on that, but that's why I never sell my properties. I buy them, I depreciate them, I 1031 exchange them, I'll own them forever, and if I ever sell them, I'll own a ton of tax, but when I sell them, I'll also make a ton of money, and that's life. So you can choose whether you leave the money locked up in those properties, or you can choose whether you sell them and then eventually pay the tax. That's why another really cool strategy is either 1031 exchanging, or you can refinance, because anytime that you're essentially taking debt out of the property, you don't have to pay tax on that either. So there's so many cool ways if you're investing in real estate to literally never pay taxes, to continue to defer those taxes, and it's awesome. Now, I'm sure a lot of you are saying, Chandler, this sounds too good to be true. And you're right, but you're not, because here's the scenario. A rental property really is a business, and if you accelerate the depreciation, but that business continues to go up in value and the cash flow on it continues, your year one, you can use it against your other income and your cash flow. But then you use up all the depreciation pretty quickly. So now if that property, like I have some properties that are now making $70,000 a year in cash flow, once I've used up the depreciation, now not only do I not have depreciation to use against it, but I also have this cash flow that I'm going to have to pay tax on. So the only way to stay ahead of it is by continuing to buy more and more properties. So if you ever hit a year where you can't buy properties, you're going to have income that you're just going to have to pay tax on, and that's okay. One other really cool thing about this strategy, as long as you continue to buy rental properties, is a lot of people will say, Chandler, if you use this strategy and you're not paying anything in taxes, won't that affect your debt to income ratio so you can't buy properties? Well, this is another cool thing, is depreciation is not viewed the same as expenses for your business, because people know that's not actual money going out. And so when the banks look at it, it's treated as if it doesn't exist. So it doesn't affect your debt to income ratio, which means you can continue to get approved for debt on more properties, you can continue to buy properties, and as long as you're buying properties, you can continue to avoid or defer taxes. Now, everyone says, Chandler, at some point, you've got to sell the properties. Well, maybe, or I die with all of this debt and all of these properties, and I've made tons of cash flow in the process, and I leave them to my kids. And yeah, at some point, if they're sold because you want to pull all the cash out without having any debt tied to it, and you want that security, you're going to have to pay tax. And that's the biggest thing you need to understand with this video, is there's no such thing as truly avoiding tax. You can defer it, or you can do something that the government really wants you to do that most likely has limitations for you, but at the end of the day, all you're doing is pushing taxes back, because one way or another, the government's gonna get you. And if the government isn't going to get you, odds are it probably isn't a real tax strategy, or if it is, it's a little sketchy and it's probably something that I would say maybe you should consider avoiding. Now, if you guys enjoyed the video, make sure you remember to smash the like button, subscribe to the channel, and hit the little bell. If you're one of those people that's saying, Chandler, I wanna start using cost segregation, this sounds incredible, I actually included the people that I use, and they're nationwide and they're awesome. So I've put a link down below. All you've gotta do is say, hey, Chandler sent me, they'll hook you up. I already talked to them about that. So that's one other thing that you can look into. And if you've got any other questions and you want more of an explanation, I will do future videos on cost segregation because I love it. And make sure that you hit up Be Charitable. I'm telling you guys, this is a nonprofit organization that is helping tons of people get a big advantage when it comes to avoiding tax by doing the right thing, and I love that. So hopefully you enjoyed this video and have a great day.